Hey, what's up, guys? Welcome back to our YouTube channel. And today I want to talk about something different, technical analysis. Okay, and this is not a market chart breakdown, so I'm not breaking down the markets to show you what I've done or what I'm expecting in the markets. We've been doing that for quite some time, but today I want to show you some things that you need to look at when you're analyzing the market, what you need to look for, the patterns you're paying attention to, because there are a lot of things in the markets that are very important that a lot of us don't pay attention to. Things like the candlestick. When you're looking at a candlestick, you need to understand the candlestick anatomy. I know you've read in the books pin bar, marubozu, hammer, doji, and what have you. All those candlesticks have different names, and inside them is ingrained a lot of details, a lot of information of what the candlestick is telling you about the market, depending on the time frame. Okay, now remember, you have 3 time frames you need to be looking at: the higher time frame, the trading time frame, and the lower time frame. Those are 3 time frames that you need to have in your trading plan, need to know what you're looking for, because in trading, if you do not have a consistency of your approach, then you'll not have a consistency of return. You need to do the same thing over and over again. That's what trading is all about. It's quite boring. It's not fun. It's not like I'm looking for action. Let me make some money. Let me feel good. Let me make money here and travel and go and buy some stuff that you might want to buy, some luxury stuff. That's not trading. True trading is all about slow approach, a simple approach. Actually, that is very important. Very simple approach, okay? And something that is well to understand, okay? For you especially, something that complements your personality, your approach in the markets, okay? Because the markets have different approaches. There are many different strategies out there how to trade. I know you've heard of them. You've seen us trading different strategies. The strategy I trade is totally different from the strategy you're trading. But at the same time, there's some things we share in common. What is your risk management? What is your psychology state? Okay, especially risk. That one is normally need a consistent risk management approach. Psychology, we are all built different. We're all born different, so that's personal also. But things like backtesting, journaling, writing a trading plan, all those are important in the Forex market. But today, I want to share a little secret about the technical analysis, because I personally believe I'm a pure chartist. What does that mean? I basically rely all my information from market structure, market narrative. Now, I'll talk about 2 things before I get into the charts, okay? I'll talk about price action and market structure, okay? I want you to understand the difference so that you can understand how to analyze better, how to approach the markets in a much in a deeper understanding way, okay? So if you have a pen, if you have a notebook, write this down, okay? So 2 things, 2 distinctions, okay? Price action and market structure. Now, price action is dynamic and market structure is static, okay? Get the difference. Price action is dynamic, market structure is static. Now, market structure is what you're seeing in the charts. What has happened before, it is static because that will never change. What is a candlestick that's closed is already imprinted in history. That will never change. If a candlestick closed as a marubozu, as a pin bar, as a doji, that is already happened. It will never change. If I look at that same chart 50 years from now, it's going to be that same candlestick that happened on the 27th of September during a certain time frame. Okay, so that is fixed. But price action is always dynamic. It's always what is happening at the present moment, okay? So the next distinction is just what I'm talking about. It's in line with what I'm talking about in dynamic, because I have to talk about those 2 things together. Price action is dynamic and present, okay? Market structure is static and in the past, okay? So note down those 2 things and understand the difference. Market structure is static and in the past. Price action is present and dynamic, meaning it is in the present moment and it's always moving. Now, you can never go in front of the present moment or behind of the present moment. It's this very moment, each and every second. That 1 minute candlestick, that 2 minute candlestick, 5 minute, 10 minute, 1 hour candlestick, that candlestick that you're seeing forming is because of price action. Price action, that fluctuation, that move up and down is all about price action. Now, when price action has completed and certain time frame has passed, be it 1 hour, 4 hour, daily chart, depending on the price action you're looking at, weekly chart, 1 minute chart. Once that time frame has overlapped, okay, the candlestick closes and it creates market structure. Now, market structure is what is left behind by the imprints of the price action that was forming in the present moment. Okay. Now, what is of importance? Because some of you might ask, which one is of more important? Is it the price action or market structure? Now, both of them complicate one another very strongly. In that, market structure gives us a good understanding of what happened in the past and what I should expect to happen in the future with a probability, not certainty, okay? Now, since it's in the past, the market structure, it can help us understand what patterns that we're trading, do tests on them, backtest them, see what happened, see what was the outcome. Was it a positive expectancy system? Was it a negative expectancy system? And just teach you different things. Without market structure, it will be very hard for us to even understand how patterns work, how they formed, what's the backtest, what's the data on that. So market structure is that important up to a certain level. Okay, up to a certain level. Now, when it comes to the real trading, daily trading, what gives you bread and butter on the table, what feeds you, you need to deeply understand price action. I don't care what strategy you're using. I don't care if you're a trend follower, contrarian trader, you're looking for sideways movement, you're looking to be net bullish or net bearish trader. All those do not matter. If you're looking for a top, if you're looking for momentum trading, all those rely on one thing in order for you to trade successfully, and that is price action. Because if you can understand what is happening on the price action in the present moment, then you can interpret that to try and anticipate what can happen moving on. Now, it's very important for you to understand price action. Personally, I read price action, but still at the same time, I always wait for the candlestick to close. As much as I'm in the present, I'll wait for the candlestick to close to give me more information, a solid information of what is actually happening in the markets. Because when price action occurs, it creates candlesticks which end up creating market structure. Now, those candlesticks, the different candlesticks, you need to understand the anatomy of a candlestick, what makes up that candlestick. Every candlestick has information. Everything that has happened around the world is embedded on that one price action. If there was panic selling, irrational exuberance, if there was massive buying, all that is printed and formed on the candlesticks, okay? So that's one of my main things that I wanted to talk about. Now, my main thing I want to talk about is one short secret that I want to share with you that I teach my students here at Financial Hub in the offices. And my traders, the alumni, I tend to teach them that, and they pay a lot of attention to it. Now, most of us take it for granted, okay? We neglect it, we think it's not that important, okay? Now, for me, I've been trading for the past couple of years. I've seen this over and over again, and this information is very, very important, especially if you want to improve yourself as a trader and improve your approach in trading. Now, personally, I'm a trend follower. So if you're a trend follower, this is a very good system that you want to be looking to trade, okay? If you can understand this system well, incorporate it in your trading, then trust you me, my friend, you will avoid a lot of bad mistakes and you'll see a lot of improvement in terms of your trading. But at the same time, it has its consequences, which I personally don't mind. And the consequences is I do not get that many trades in a month, okay? It reduces the amount of trades, but really increases the quality of the trades. So quality over quantity. Make sure that's what you're doing in trading. I don't want to be that trader who's telling people I've taken 50 trades in a month and this is what I'm looking for now. Personally, I believe the more trades you're looking for, the harder it is to make consistent income. Less is more, even in trading, okay? So I'm always reducing. I'm reducing the pairs that I'm trading. Currently, I only trade 3 pairs. I'm reducing the amount of strategies that I'm trading. Currently, I'm only trading 1 pair. I have a consistent approach to my risk management. I have a consistent approach to my trading plan. All those things are consistent, okay? And that's when I say trading is a bit boring. But at the same time, if you understand trading, it's quite fun. It's fun to me. It's boring in terms of there's no action, but it's not boring in terms that I open the charts and start yawning. It's always a way of looking for consistent approach in order to have consistent returns. I hope that is embedded in your oblongata, in your brain, okay? So moving forward, let me share with you this secret that I want to share with you here on the chart. So what you're seeing on my chart, and I'll show you this example with different markets, okay? So as you can see on my screen, I only trade these 3 pairs, USD CAD, Aussie dollar, and gold. Now, I'm heavily a I'm heavily a dollar trader. So all my pairs are dollar related. So most of my trades, I'm normally looking to get entries during New York sessions, sometimes during London sessions, because if you're a trader, you know those 2 times overlap, okay? But for now, I want to look at the dollar index and I look at US oil and Euro USD just to show you what I'm emphasizing on, so that you can see that it's not a biased approach on only one pair but multiple of pairs. But also I deeply teach this in class. So today I want to go deep into it. I'll show you a bit of it, but when you come for my classes, I'll teach you how to approach it in a much better way, the steps you need, the criteria that you need to be looking for. But in this video as well, you've been following us for some time, and I want to give you some gems so that you can improve your trading strategy. So what you're seeing on my chart is the dollar chart. Okay, so let's go full screen here. Now, before we go full screen, yeah, let's go full screen. So you can see this is the dollar chart, okay? And one thing I want to teach you, like I said, if you heard me well, I was talking about I am a trend follower, and I want to teach you how to be looking for the trend. Now, what I want to talk about today is deep understanding of the Dow theory. Okay, now when I stumbled upon the Dow theory, I never used to pay attention to it much, and I never used to understand how to use it. So it took me time before I understood how to use it practically, not just theoretically, and how to also trade using it. Okay, so Dow theory basically states that the trend will continue until the trend breaks. Not just like that, but it also further says that the market will continue in a series of higher highs, higher lows when it's in an uptrend until that pattern breaks. When that pattern breaks, then there's a high chance market is changing direction, okay? And the market, likewise, vice versa, market will continue moving in a downtrend in a series of lower lows, lower highs formation until that pattern is broken. So if I just draw that over here, if you look at this, so when the market is moving in the direction of the trend, you want to be seeing this, okay? That's what you want to be looking for. Market is forming successful formations of higher highs and higher lows. However, when market comes and breaks that structure, you see here, when market comes down and breaks that structure, okay? At that level, let's mark that level here. Okay, then there's a high chance market might be changing direction. Okay, and it's usually, I'll show you a couple of tricks that normally goes up here, but there's normally a high chance that at this level market can trap a lot of buyers and a lot of sellers at the same time. Okay, now notice one thing over here, market is in a successful uptrend forming higher highs, higher lows series. Okay, at this point of higher low, market pushed to a new high. However, when it came down, okay, it wasn't able to sustain above that level. Instead, it broke back below. Okay, now there's usually a trap here, and I'll show you a couple of these. There's the sell trap when market is doing this change in direction. Okay, there's a sell trap in that a lot of people tend to start selling immediately market just breaks below. Okay, now what happens in the market, because I've been observing it and done backtesting for some time, at this trap, remember, most people are looking for these markets to continue moving to the upside. Okay, so what usually happens after that break, market tends to come back above that level. Okay, immediately after the break, after some time, market tends to come back above that level, and most people start saying what? Market is continuing to go back in the uptrend, and the people who enter this first sell start to get their losses over here. Okay, so as market is moving up, the sellers are losing money. So this is a sellers lose. Okay, they start covering their losses. Okay, and what happens at the same time when they're covering their losses? Remember, when the market is selling, when a group of people are selling, there's usually someone buying. Okay, so it happens simultaneously. So at this point, you're finding buyers. Okay, but at the same time, this is a buyer's trap. Okay, there's a sell trap and there's a buy trap. The buyers are trapped also here. So what usually happens? What happens at this point? You tend to see market then pushing back down. Okay, immediately. So the people who bought after this break, market has broken back below, maybe even retest, then starts a downtrend. Okay, starts a downtrend. Okay, until a certain level. Okay, and that usually repeats itself. You tend to see market respecting those levels as long as it's moving to the downside, and then another trap is formed here when market again is changing direction. Okay, same thing happens when it's in a downtrend. Market comes, breaks above, breaks that series of lower lows, lower highs with respect to the Dow theory principle, and then comes up, breaks that level, gets a trap for the buyers are trapped here, moves back down, the sellers are trapped, okay, and then market starts moving to the upside. Okay, now you see that happening a lot, especially now that I've given you that secret and I'll show you practical examples. You're going to see it happening a lot. But at the same time, market doesn't necessarily have to be in a trap. Sometimes it can come, break down, retest this level, okay, just come, break down, retest that level, and then eventually go to the downside. Okay, maybe even form a double top and even continue to the downside. So sometimes that happens. It doesn't necessarily have to be a trap, but I've seen this happening a lot, and it's usually a trap. And I'll show you different markets that showcases it nicely. Okay, so it's important to pay attention to that. The break of the previous higher low or the break of the previous higher lower high, depending on the direction the market is moving on. Rather moving to, okay? So I hope that has been ingrained. Now, something else that you need to pay attention to is, and this is something, small secret, small improvement that really changed my trading approach. Now, when you're paying attention to the direction of the market moving, okay, you need to be very sure of the time frame you're paying attention to. Now, if you paid attention, I mentioned three trading time frames, okay, that you need to have. You need to have your higher time frame, which you call HTF, okay. You need to have your trading time frame, which you call the TTF, and you need to have your lower time frame, which you call the LTF. Okay, so all my students know this. We normally talk about this. Now, what is the HTF all about? TTF and LTF. Now, the HTF should show you the big picture, what is happening in the big picture in the market. The TTF should show you the trading time frame. That is the time frame you have to pay a lot of attention to when you're looking for trades. Okay, and then you have a lower time frame, which can help you get very early entries when you're entering in trades. Okay, for example, I personally have my HTF as the daily time frame. So the daily chart is giving me the big picture of what is happening in the markets. The TTF for me is the 4 hour. Okay, that's what I'm looking for most of my trades. That's the best time frame that I get my very good trade setups, and have my LTF, which is the 1 hour, which gives me very, very good entries when I'm looking for trades. Okay, once I get a higher time frame telling me the big picture, I get a trading time frame, a pattern that is in line with the direction I'm looking for, then I go down to the LTF, which is the 1 hour, to get a very good early entry in the markets. So you should have that with respect to those three time frames. Okay, I don't care how many time frames you're looking for, but use this as a guide. Now, let's say you're a short-term trader and you're not really looking for like daily chart and all that. Maybe that is too high. Then you can shorten it. You can have your higher time frame as the 4 hour, the trading time frame as the 1 hour, and your LTF as the 15 minutes. They should at least have a multiple difference of at least 4. Okay, 3 to 4. Okay, you can't have your lower time frame as the 1 hour, your trading time frame as the 2 hour, and the high time frame as the 3 hour. They do not give a story. They do not complement one another. They're almost one and the same. Okay, you should have a big difference of a multiple of between 3 to 4. Like for example, like what I'm saying, 15 minutes, 4 15-minute charts. 4 15-minute candlesticks will give you one candlestick on the trading time frame, and 4 of them will give you one on the higher time frame if you're using with respect to the 4 hour, 1 hour, and 15 minutes. For example, mine has a multiple of 4 and 6. So the LTF has a LTF to the trading time frame multiple has 4, because this is 1 hour and my trading time frame is the 4 hour. Then the trading time frame to the HTF has a difference of 6, because the 4 hour, and over here I have the daily chart, which is basically 24 hours, which is 4 times 6. I get that. So use that as a guide. Always use it as a multiple of 4, and I believe that will help most of you traders, the ones who are really starting out especially. So let's go back to the Dow theory. Okay, I want us to look at these traps, look how people get stuck and how they get trapped and what you can learn from it. Okay, so I'll start with the dollar. Okay, I'll start with the dollar. I won't really go far because it starts from back then. Let me come and start up here when the market was during COVID. So this was March 20th. Okay, I mean March 19th, 2020. At this very top. So what happened? Notice how market started moving in a downtrend. Okay, forming lower lows, lower high. Now in my classes, I show you how to mark the lower highs properly, because the lower high is not this one and it's not this one. But if you come for classes, I'll teach you in-depthly how to mark them. But anyway, this is an impulse, then you have a correction. Okay, that is the lower high. Lower low, lower high. Okay, that's a lower high. I tend to mark them with these arrows, red to the downside and green to the upside. Now notice how market formed a lower low, lower high. So market is respecting the formation to the downside using the Dow theory, okay, as a principle, okay, not as the force that is pushing it. It's a principle, okay. Don't confuse the two. It's not that Dow theory pushes the market. What pushes the markets to go in any direction is simply supply and demand. That's what pushes market to move. But we use the Dow theory as a principle to help guide us when to know when the market is about to change direction and such stuff. So here we got another impulse to the downside, you get another lower low, okay? So look at that series, lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high. Now notice that market never broke that pattern. It never went back above those lower high levels, okay? So we're paying attention to it. Now pay attention here. When market came here, after forming this lower high, market was going to form a new low. However, it failed to create a new low. Okay, and what happened shortly after that? Market came, retested that level, tried to push down, and then eventually broke above. Okay, now this is the level I'm telling you. This is the trap. Okay, notice that this trap, how market came, broke above immediately. Now you have the buy trap. Okay, you have a buy trap here. Buy trap. You have a buy traps there. Then what happens immediately? Market goes down. So all the people who bought at first start having losses, okay? So what happens to them? They start taking out their losses at around this level, okay? You have losses on there for buyers, okay? So you have losses for buyers. Then what happens shortly after that? The sellers, remember, when the buyers are coming out, of course, they're selling their position. There has to be sellers, okay? So you have sellers coming in, okay? But at the same time, like I said, this is a sell trap. What happens shortly after? Notice how markets tried to push lower, didn't even go any further lower, then broke above. Okay, now this second time, this was the best entry, the best trade to get. Okay, now remember, we are focusing on what time frame? The daily time frame. Okay, I don't know if I mentioned that, but let me mention it now. I'm focusing on the daily time frame. Why? Because the daily time frame has more significance in it. Unlike the 1 hour, which markets can be in an uptrend today morning and in a downtrend tomorrow in the evening, we don't be focusing on that using the Dow theory. So my Dow theory, I'm paying a lot of respect to the daily chart. Okay, now notice how market impulse to the upside, correction, retested that Dow theory level, and market ever since marked my higher lows with the green arrows. Market has just been an uptrend, higher high, higher low, okay? Higher high, higher low. Higher high, higher low. Notice how markets change direction completely. Higher high, higher low. New high, higher low, okay? Higher high, higher low, okay? Higher high, higher low. Higher high, higher low. Now the trap came in here again. After this higher low, market failed to create a new high, came and broke the Dow theory level, okay? And like I said, usually a trap, fast sellers enter a trap, immediately goes back up, buyers start buying, also getting, they make a little bit of money, okay? Remember, at the same time, it's not that markets really just comes here and just goes down very quickly. This move from here to here is a big move, so they can make quite some money. But in the end term, in the long term, okay, market strongly impulses to the downside. Just one candlestick has taken out 4 days of price action, and market moves to the downside. Now notice how markets change direction. Now lower low, lower high, lower low, lower high, lower low, lower high. Okay, notice here, lower high, lower low. Market came and retested the lower high, which is totally fine. Market doesn't necessarily have to break above it. It can act as a resistance level. And then market came, retested this level, didn't break, came up, came here, and then eventually pushed to the downside. Okay, market broke below that level and then started coming back up. So it created one lower low and then came up. Now notice over here, market came for the previous lower high, broke above it, came and retested, came below, broke above it, okay? And in this time, market didn't do the retest, it just continued moving higher. So there's usually a sell trap here for the people who are trading trend following, okay? Usually a trap, that's a sell trap as well, okay? And the trap also over here for the sellers who try to start selling here, market eventually comes, breaks above, and then starts. This is my first sign of changing direction, but this is also a better confirmation that in the long term, the bulls have it more than the bears, okay? So that's current price action. This is what is happening at the moment. So I'm net long on the dollar. As much as we might get corrections, and this correction can come heavily, come back to these levels below, but long term I'm looking for longs on the dollar rather than the shorts, because I believe if you're trading in the direction of the trend, your risk is much less controlled than when you're trading against the trend. Okay, now that's just one example. If I come here and look at another pair, okay, so that you can see that it happens a lot now. I could look at Euro USD because they're more or less correlated with the dollar index, just that it's vice versa in the opposite direction. But if you look at it, I won't even spend too much time on it. Same thing. Okay, look how market here went in an uptrend. Okay, this is my Dow Theory. Okay, notice how market was forming higher high, higher low, higher high, higher low, higher high, higher low in the form of a double bottom, higher high, higher low. Went up, tried to fail to break to the new highs, came back down. Notice how market broke below this level. The trap happened again, the sell trap and the buy trap. Then eventually markets changed direction to the downside for the long term. Notice how market went lower low, lower high, lower low, lower high, lower low, lower high, in the form of a double top. These are the best double tops we should be looking for, and these are the best double bottoms you should be looking for. Now, people normally have it in the wrong direction. Most people are looking for a double bottom at the down level, at the bottom of a trend. And people are normally looking for a double top at the top of a trend. Now, for me, I don't do that. I look for a double top in the path along the downtrend, okay? And I look for a double bottom in the path along the uptrend, like this, like somewhere along. I don't look for this at the bottom of a trend, because rarely do market reversals occur successfully. So looking for double tops, double bottoms, trust me, my friend, you're going to pay a lot of money looking for that. So if you've caught that, use that as a principle. If you're a double top, double bottom trader, look for that principle, okay? Double bottoms are best found in an uptrend, and a double top are best found in a downtrend, okay? I know it's opposite of what you learned, opposite of what you know, but trust me, that's what I've observed, and that's how I've been trading successfully at the same time, okay? So look, markets continued lower low. I don't know why this one is not marked. Then you get that lower high, okay? Markets went, formed a new lower low, lower high, lower low, lower high, lower low, lower high, lower low, okay, lower low, lower high. Then market failed to create a new low, came and entered into that trap again. The buy trap, buyers buying, sellers coming, everyone gets trapped, market eventually changes direction. This is the sign that market is changing direction, okay? And then what do you see happening? Higher high, higher low, higher high, higher low, higher high, higher low in the form of a double top. I told you double top, in the form of a double bottom. And like I said, best double bottoms are found in an uptrend, not at the top of the trend, okay? So market here continued higher high, higher low, higher high, okay? Markets have now broken below the previous Dow Theory level. You can see same trap again. Markets broke below, came, so quick sellers, buyers, all of them trapped. Then eventually market has changed direction, okay? So now I'm sure you get the gist of it, okay? Look at something like oil, same thing, okay? Look at this. Let's zoom a little bit behind. Let's start down here. Market has been in an uptrend since COVID, okay? Dow Theory level broken. I've drawn it from way behind. I won't go all the way back there because I'll waste so much time. So look at this one, okay? Look at this. Higher high, higher low. Higher high, higher low in the form of a what? I won't say it. I'm sure now you already get the gist of it. But for those who do not understand, higher low in the form of a double bottom in an uptrend. Best double bottoms are found in an uptrend. I won't stress that anymore. Okay? I hope you understand it. I'll never mention it again. If I do, maybe because some of you didn't understand and I want to help you. But anyway, I teach that in class. That's a few gems that I've given you that you can carry home. Higher high, higher low. Higher high, higher low. Higher high, higher low. Okay? Higher high, okay? Higher low. You getting that? Okay? Higher high, higher low. In the form of a what? A double bottom. Best double bottoms are found in the direction of the trend. You can see that level there? Okay, more of a double bottom. It's really a small tiny spike, not really touched perfectly, but take that to your bank account. It works most of the time. Okay, look at this one. Here we go. Higher high, higher low. Again, in the form of a double bottom. Okay, over here. Okay, markets pushed up. Now notice at this level, this is the Dow Theory level. Market failed to create a new high. Okay, failed to create a new high. Then what happened? Markets came and broke below. Okay, notice that. Markets failed to create a new high, came and spiked below, started moving back up, a trap again, like I said, then markets eventually came and broke below, and then oil entered into a downtrend. Now look at this, lower low, lower high, lower low, lower high, in the form of a what? A double top. Best double tops are found in a downtrend. I won't say that again. Okay, I'll just say it again. Let me just continue so that you get it in your mind. Lower low, okay? Market respected this level. You get a double top again. In a what? Downtrend. Markets move to the downside, okay? Now here is where we got a sign of a change of direction. The trap again, okay? The Dow Theory level is here. Markets broke slightly above. After creating this lower high and lower low, markets created that spike above. Very good trap. Markets closed back below, moved to the downside, got a double bottom at this level, and then eventually came and confirmed this break. Okay, because if the seller sold here, yes, it's a sign, but not a really good sign yet. So if you sold here, you're still good. Okay, the markets are not perfect. They won't happen perfectly. Not what I'm telling you is now textbook or ingrained in stone that it'll always be like that. Markets always changing and always shifting. So you see now here, markets came, same trap again, broke above, buyers got trapped, came back below, sellers got trapped. Eventually, the market is now in an uptrend. And I believe this market will continue moving in an uptrend for quite some time, okay? That's how it happens, okay? As long as you're respecting the Dow Theory, that's what happens. Those are a few random pairs that I don't trade, but I wanted to share that. I can remove them from here. If you look at other pairs I trade, look at gold, for example. Same thing. Same thing. Look, when market was in a downtrend here, lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, failed to create a new low, came and broke above the previous lower high, retested that level, then went higher high, okay, over here, higher high, higher low. It's actually here, okay. Created a new higher high, higher low, higher high, higher low, okay. Now notice higher high, higher low, higher high, higher low, higher high. Market came broke below the Dow Theory level, retested it, came down, came back, formed another retest of that level. Like I said, another double top found in a downtrend. Please, my friends, understand that. Before I understood that, I traded for about 4 or 5 years. It took me time to understand that, okay? Double tops are best found in a downtrend, and double bottoms are best found in an uptrend. Now, something like this now, this is a big double top, okay? Now, these ones rarely occur, okay? Look at this double top, rarely occur, okay? Because it's a double top in a very big picture uptrend, okay? This is actually a big picture consolidation. It's not even an uptrend. If I pull this all the way behind here, you'll find that this is just, it's a sideways moving market. It's sort of like a ranging market, okay? But anyway, let's focus on what we're here for, the Dow Theory. So a break of that level, retest, market has been in a downtrend, new lower low, lower high. Look what is happening in the market. A push to the downside with a lot of momentum. Today, market is down about 0.5% on the gold, okay? Just by respecting the Dow Theory analogy, principle, okay? The theory, the Dow Theory principle. Look at this one. Let's remove this trend line. Okay, I'm not big on trend lines, but I also look at them. Look at this, a double top in this direction of the downtrend, okay? Happens a lot. Now, if you come and look for a double bottom, let's say you're coming here, you're saying, okay, here there might be a double bottom, market is going to change direction. I never look for a double bottom at the bottom in a downtrend. Looking for a double bottom in a downtrend, you should do the opposite of what you're reading on the books, what you're reading online, okay? And I think I've taken enough time to stress it in this video. Understand that. I've talked about different things in this video, a lot of nuggets that I look for, what I trade, okay? I've shared with you almost half of my trading secrets, what I'm normally looking to trade successfully, okay? That happens on gold. Look at Aussie dollar. Same thing. Market is in a downtrend long term. Look at that. Okay, downtrend long term. Look at USD CAD. Okay, same thing. Look at that, downtrend long term. Dow Theory changed here. Looking for more bullish plays on the USD CAD on this one. So that's basically it. Okay, today nothing much apart from what I've shared to you. I've not shared any way of how I look at markets, what you're normally doing with the market narrative. I mean, market breakdown, looking to buy, looking to sell, what trades I have. Today, I wanted to share with you a few principles of how you should trade in order to become a professional trader. It's very simple. Trust you me, it's very simple, but very hard to use, okay? And that's what trading is about. Trading should be simple, but there are hard things inside it that make it harder and sophisticated and a bit not so easy to approach, but at the same time, it needs to be very simple. And that's what I do on a big picture time frame. I've shown you my higher time frame. Now I normally break that down from a higher time frame to a trading time frame. What patterns am I looking for? Then I break it down to the 1 hour, which is a lower time frame, which now I teach my students how to look for very good trade setups. But what I've taught you today is also very, very important. Whatever trader you are, whatever strategy you use, focus on paying attention to the Dow theory with respect to the daily chart. So I hope that has helped. I hope that has been can be added into your arsenal. Let me know in the comments below what you think about it. Anyone who trades Dow theory, let me know what time frame you trade, which pairs you look at. Just comment. Let's be active. I'll make sure to comment below also and be engaged with a couple of you, because at the end of the day, I like looking at the market from a chart analysis point of view. I don't use indicators. I don't use I only use one more tool, which I teach my students. So that's a bit proprietary and how to set it up. But apart from that, I focus purely on what the chart is telling me. Price action, market structure, combine those two, trust me, boom, you have a different approach to the market. It can improve your trading strategy and you'll see a lot of improvements in terms of the returns you're having. So apart from that, pay us a visit here at Lavington Mall. Come visit us. Let us teach you how to approach the markets in a good way, because I personally did not have anyone to guide me, to show me the ropes, to give me the step-by-step guidance, to give me the compass of where I need to go and what I need to do. We never had that when I was starting out about 7 years ago. But now the industry has really established itself. We have put ourselves on the map. So come to us, come to our Lavington Mall office, come talk to us, let us teach you how we trade that. And at the same time, we have also launched our new product and service, the new course, which is called Project FX, how to get funded. So using these simple strategies that we use, we also teach you how to pass, how to trade, how to pass, and how to maintain your prop firm accounts and get funded over $100,000 and up to even higher, depending on how far you can scale it up. So come visit us, let us talk to you, let us see what you can do. But at the same time, make sure you're trading your strategy in the right way, and we're here to offer a guide of how to approach the market. So I hope you've enjoyed that video. Hit me a like, share this video, give me a thumbs up on the below, and please comment and let me know what you think about this and about any other video you want me to share. Like another video I might share is how to mark my key levels, how I draw my key levels and all that. I do it totally differently from the conventional approach, and I can also do that in another video. So that's basically it for me. I know I've made this video quite long, but that's how my classes are. They're quite long, extensive, but very, very deep, giving you an understanding of the markets, okay? So all the best in your trading career. May the pips be with you, and I'll catch you later. Peace.